After reviewing these current events, you can see how financial analysis is very important because it can help you analyze the financial health of your organization at its current state and make proper projections of where it can be. Even though there's uncertainty in the future, you can't necessarily predict with 100% certainty. It will give you ideas of what will be opportunities and threats to the organization so you can plan accordingly. Let's visit back the financial statements that are very critical to our analysis. The balance sheet, which encompasses the assets, liability, and net assets. In the corporate world, net assets are labeled as equity. The operating system statement, which is also known as the income statement, shows the revenues, expenses, and net income. These two financial statements are very important in computing the financial ratio analysis. With the financial statements, you're able to conduct a thorough financial ratio analysis. Oftentimes, institutions such as banks use this type of analysis to do a credit analysis. This is a way to assess whether your institution will default on the loans. We can use a similar criteria to assess the organization business operation. So I'm going to take some of the common tools that are used in credit analysis and implement them in financial analysis so that you can see that there's an overlay. This is the standard way of conducting a credit analysis of an organization financial health. The first step is to assess the nature and the purpose of the project. Second is to understand the microenvironments and the industry conditions so you have something to compare with. Next, you will conduct a thorough financial ratio analysis. This is information that's extracted from the balance statement, the balance sheet, and the income statement or operating statement. And then you will conduct a pro forma, which is a type of statement where you will make projections based on what you understand about the industry and with relatively reasonable assumptions. This specific lecture series will focus on the financial ratio analysis, which is step 3. Financial ratio analysis is taking data from the operating statements, which is sometimes called the income statement, and the balance sheet to conduct the analysis. It's a way to examine the strength and weaknesses. Remember, we did the SWOT analysis a few weeks ago? You could think of it as a ratio analysis is doing a type of SWOT analysis, but using numbers. It is also a great way to have a better understanding of how your organization works in relation to the industry, because now you have numbers to compare. For example, using your balance sheet, a $1 million assets may seem to be a lot of money to your organization, but if you compare it to the standard industry numbers, maybe $1 million is quite low. Maybe in comparative industry similar to yours, $10 million of asset is the acceptable criteria. So therefore, these type of comparisons are very important, but you also need to look at the ratio. So let's say the other organization has $10 million of assets, and it may seem a lot compared to your $1 million of assets. But what if their liability that they incur in debt is 1,000 times more liability compared to yours? Then in that case, maybe even though you have $1 million of assets, if your liability is half of your assets, your financial ratio is actually higher compared to another organization, even though on their balance sheet the numbers may seem to be a lot bigger than yours. There are several different types of financial ratios. The first one we're going to talk about is liquidity ratios. These are ratios that allow you to assess the capability of your organization to turn assets into cash or cash equivalents. The question you can ask using these ratios are, does the organization have enough liquid assets to meet its short-term obligation? Notice that I emphasize on the word short-term. And does the organization have sufficient liquid assets to carry out planned financial transactions? This is very important to understand whether you have enough information, cash, and also information regarding to the industry, whether to invest in a project for the future. The four ratios that we're going to discuss within the liquidity discussion is the current ratio, quick ratio, days cash on hand, and days in account of receivable. The current ratio describes how well an organization can pay its liability using current assets. This information is extracted from the balance sheet. And ratios that are typically larger than 1.5 is pretty good. So the example that I gave, if you have an assets of $1 million and your liability is only $500,000, that's pretty good because then your ratio is 2.0. Now, if you have an assets of $10 million of assets and your liability is $100 million of liability, that gives you a ratio of 0.1. So even though it may look like another organization has a lot more assets, but if their liability is a lot more than yours, the financial ratio in this organization was 0.1, which is very, very bad. So in conclusion, the current ratio is the current assets divided by the current liabilities. So that's how I got those ratios. Is 1. And this is an example of where I highlighted where the numbers were extracted from. If you look at the balance sheet, you will look at where the total current asset is where I circled in red, and you will take the total liability, which is where I circled over here, and you basically take the numbers, current assets divided by current liability, and that will give you the financial ratio of the current ratio. The quick ratio is another way to assess how well your company's liquidity is. The only difference between the quick ratio and the current ratio is that you are only taking an account of the current ratio minus the inventory. Why do you think they minus the inventory? The reason why is that inventory is considered the least liquid because once you have items on the shelf, it's going to take a while for it to be sold, and for after it gets sold, if it's sold by credit, it's going to take a while for the credit company to reimburse your money. So all of that's going to take some time for the inventory to be turned into cash. So therefore, to understand the quick ratio, which is you could think of it as a quick way to understand how much liquid you have in your company, you will only look at the current assets minus the inventory, and that number is then divided by the current liability. Now that we just went over current ratios and quick ratios, what do you think is a better ratio to assess? Well, they're actually both. It really depends on industry. If your industry is very heavily involved with inventory, it may be a much more reasonable ratio to use is the quick ratio, right? Because you want to see how much cash you have in hand. But if you are a service-based institution, you may not have a lot of inventory. So doing a quick ratio would equally be sufficient enough for you to analyze how much liquid you have because you already know the number of inventory is going to be a relatively small number. So doing that extra analysis is not as necessary. The other ratio that's very important to look at is the days cash on hand ratio. This is information that extracts information from the balance sheet and the operating statement. Sometimes the operating statement in some industry is called the income statement. Just make sure that you are looking at the total operating expense from the operating statement and the depreciation and amortization costs. So this is a formula that describes the days cash on hand. You basically take the information from the balance sheet, which is the cash plus cash equivalent, divide by the total expense, the total operating expense minus the depreciation plus the amortization. You take this information and divide it by 356 days. And this information is taken from the operating system. So how do you know what is considered an acceptable ratio? If in the current ratio, we knew that anything above 1.5 is considered very good. Well, this really depends on your industry. The next ratio that we're going to discuss is days in account receivable ratio. This information is taken from the balance sheet, specifically looking at the receivable component of the balance sheet and looking at the total operating expense, which is taken from the operating statement. Remember, the operating statement is sometimes called the income statement depending upon the industry that you're looking at. This is a summary of where the information is taken. The account and receivable, which is information taken from the balance sheet, and the average daily revenue is taken from the operating statement. You are able to compute the average daily revenue by taking the information on operating revenue divided by 365 days. That will give you an average daily revenue. You take that information as the denominator and you divide the account and receivable divided by the average daily revenue. So how do you know whether your ratio is acceptable or not? Is it above a certain number? In this specific scenario, using the days cash on hand and days cash and receivable, it really depends on the industry. So this is where you need to do some homework to look at who are your competitors in your market and to look at what is publicly available on their ratios. And then you compare it with your institution's information. This concludes the 4 ratios that I want to discuss regarding liquidity. Current ratio, which is total current assets divided by total current liability. Quick ratio, which is total current assets minus inventory divided by total current liability. Remember, quick ratio is a great way for industries that are very inventory heavy to understand how much cash they actually have on hand. If you're a service-based institution, current ratio will do just as fine. The last 2, days cash on hand and days cash and receivable, are information that's taken from the balance sheet and the income statement. The current ratio and the quick ratio, anything above 1.5 is considered very good. Your institution is financially healthy. The last 2 ratio, days cash on hand and days in account receivable, really depends on the industry. So there's no magic number. And this will conclude our session on liquidity. Stay tuned for our next lecture series on the next ratio that I'm going to discuss. Hello, this is Professor Kee Chan at UIC School of Public Health in the Department of Health Policy and Administration. This week, we're going to continue our conversation about financial ratio analysis. Financial ratio analysis is a great way to evaluate the trend within your organization across years, as well as compare your organization finances with another organization within the same industry. This is a recap of the 4 ratios that we discussed about liquidity: current ratios, quick ratios, which are information that's taken from the balance sheet, days cash on hand and days in account receivables are information that's taken from the balance sheet and the income statement. All 4 of these ratios are crucial to evaluate how much cash your organization have at hand. This week, we're going to focus on activity ratios. Activity ratios are an effective way to evaluate how efficient your organization is using its resources. In the first half, we discussed liquidity, which emphasizes on how much cash at hand, how much liquid your organization have. Now, let's say that there is enough liquid in your organization. You want to analyze whether your organization is using those resources efficiently. The question that you want to ask using the activity ratios are the assets generating sufficient or surplus revenue to pay for the operating financing activity of the organization? The other question you may want to ask is, was the cost of the assets well spent, or did we make budget cuts? We want to focus on the costs and revenues of the assets. The three types of activity ratios that we're going to focus on are assets turnover, which is operation revenue divided by net assets. If you remember from the two financial statements, operating revenue is from the income statement, and the net assets is from the balance sheet. The other ratio we're going to focus on is inventory turnover. Supplies, cost of goods sold, divided by the average inventory. The other third activity ratio is average payment period. This is the accounts payable, which is extracted from the balance sheet, divided by annual purchases, divided by 365 days. This will give you the average payment period. The next ratio that we're going to focus on are known as debt ratios. This helps you ask the question, how much debt is the organization making to keep up its operation? The debt ratio is known as debt over equity. How much of the organization's debt is paid by its assets? Some of the other common debt ratios are long-term debt to net assets. The other one is net assets to total assets. The last one is time interest earned. From a nonprofit organization, it is the revenue minus expense plus interest expense. That total amount divided by interest expense. These ratios allows you to understand how much asset your organization has that's available to pay out its debt. Now, when the numbers are not very positive, this is an opportunity for you to consider what will be strategies to either increase the assets or decrease the debt. And also explore other revenues to either get more loans or either to get more stakeholders to invest to increase your equity. There's a lot of different strategies that the debt ratio that can help alleviate any pressure in the organization. The next ratio is called the profitability ratios. These ratios help you examine the organization's ability to produce more revenues than expense. These are the ratios that you hope to see to be big and to be positive, and that you see an upward trend in your organization between years. It will be great to see an upward trend between years, but if your organization has the similar ratio across year, also taking into account inflation, that's a relatively okay sign as well. You want to really compare your profitability ratio against other competitors within your same industry. This is the ideal way to see where you stand in an organization. And also taking into account whether the timing of certain types of revenues being generated may be affected because of seasonal issues. For example, if you're at a retail store, you would imagine that profitability ratios would be highly dependent around holidays, around Thanksgiving sales, Christmas time, and also around back to school sales. Whereas times during the winter time where individuals may be less likely to go shopping, you will see those ratios declined during those time. So it's important to look at these profitability ratios, but also taking into account the timing of when these ratios were taken and whether your industry is dependent upon seasonal changes, economical changes, or some type of external forces. And as you learned previously, we did a SWOT analysis. And with a SWOT analysis, which you identify the strength, weakness, opportunity, and threats in your organization, you can use these type of elements to help justify why your ratios are the way they are. The three most common profitability ratios are the operating margin. This is the net operating income divided by the net operating revenue. These two elements are taken from the income statement. The other ratio is the net margin. This is the net income divided by the total operating revenue. And the last ratio to identify the profitability in your organization is the return on assets, the ROA. The return on asset is the net income divided by the net assets. The net assets is taken from the balance sheet. Let's recap the three different categories of financial analysis that we can analyze using the balance sheet and the income statement. The first one was liquidity ratio, the second was activity ratios, and the third was profitability ratios. With these three categories of ratios, you can then conduct a comparative analysis. A comparative analysis allows you to evaluate any trends between years and also across industry. You can calculate the percent change between years. Did it increase or decrease? Make sure that when you express any decrease that you show it with a negative number. Was there any warning signs beforehand? You can look at previous year's financial information and see if there was any warning signs. Did the company all of a sudden take up more debt without having increased its assets? Or was there inventory that was left on the shelf longer than expected? There's a lot of information that you could extract from the financial sheets, but it's very important to conduct a ratio analysis because that's the only way to compare between years and across industry. So for example, let's say in the first year in 2010, you had a current ratio of 0.7. And then in 2011, it was 0.8. So what you can do is identify the percent change between those 2 years. 0.7 minus 0.8 is a difference of 0.1. 0.1 divided by 0.7 is around 14%. So you can conclude that there was about a 14% change in a positive direction between the 2 years. Now let's say in 2011 you had the ratio of 0.8. And in 2012, the current ratio was 0.7. Now you would look at the difference. 0.8 minus 0.7 is 0.1, but this time the denominator is 0.8. So 0.1 divided by 0.8 is about 12.5% negative. So you can conclude here that between the year 2011 to 2012, there was a decrease of 12.5% in the current ratio. These are methods to help you evaluate the meaning behind these ratios. You could also compare these ratios between industries. So if you were given 2 companies or 3 companies, you can compare your ratio between the 2 different companies. So you look at your current ratio of your company compared to the current ratio of company B, and also compare it to company C. Look at the percent change. Is yours higher? How much higher? Is it lower? How much lower? And did you notice a trend across? What is it about their organization assets and liability that indicates that their ratios are higher or lower? There's a lot of information that financial data can provide to you about your organization as well as the industry, whether you're in an industry that is in a positive trend or whether it's stale or whether it's a time to get out of this industry. When you work on your business case study, I would highly recommend that you refer back to these questions to guide your analysis. First, calculate the percent change between years or between industry. Do you notice an increase or decrease? Was this expected or unexpected? Was there warning signs as indicated in the financial data? You can also look at the current events that was happening around that time to understand whether these are reasonable ratios. If everyone in the industry was having an economic turmoil, then it's expected that all the ratios would be either lower than previous year or even heading toward a negative trend. That's why it's also important for you to do a lot of research to understand what was going on around that industry during that time. In your analysis, be sure to compare the industry ratio and are you doing better? And why is that? Is this trend sustainable? Was this ratio due to the fact that your organization took up more debt? Is that a sustainable strategy? Are you doing worse than your competitors? Why is that? And how can you improve? Based on looking at their financial statements, is there something that you could learn and implement in your organizations? I find that numbers can tell you a lot of the stories behind the scenes. I hope that you find this information helpful as you learn more about financial analysis as well as working on your case studies.